Welcome everyone and good afternoon. Welcome to the Davidson and Company Annual Tax Update for 2023. My name is Fabian. I'm a tax partner here at Davidson and Company. We have several tax topics to get through today, ranging from personal and private corporate tax to public companies, mining, and U.S. taxes. As always with the tax world, several changes have come about this past year, and we'll try and cover as many of them as we can while we're speaking with you today. And as always, please submit any questions that you have in the area on the screen marked as such, and we will try and get back to you as soon as possible. Our presenters today are Jamie Nguyen, a private tax partner on our team, Frank Lin, a principal with our tax team that works in the Pubco tax area, Raj Momrath, who is also a principal and with our private group, Sun Kim, a principal with our Pubco tax as well, talking about equity compensation, Manesa Ho, a senior manager with our U.S. tax group, speaking about PFIC issues for Canadian corporations. Howard Chang, a partner with our Canadian group who works with a lot of pubcos and international, who will also be talking about finance and interest. And Juranyi, a principal with our tax group as well, who will be talking about the Underused Housing Tax and how to get those filed before the end of the month. So without further ado, we'll get started. We'll be starting with Jamie Nguyen and the tax changes from this recent budget. Jamie.
Thanks, Les. As Les mentioned, I'll be talking today about the budget, the 2023 budget, as it pertains specifically to private companies, individuals, and trusts. So the budget was presented on March 28th of this year, announced a lot of new and upcoming changes. Today I'm only going to be focusing on the ones that relate specifically to private corporations, individuals, and trusts, and three specific topics, the first one being alternative minimum tax, the second one being employee ownership trusts, and the third being intergenerational business transfers. So there's a lot of material here. You'll see me whip through the slides pretty quickly. The slides will be available for you guys if you need to review them later in detail. So with the first topic, alternative minimum tax, just to give you guys some background. So the government's been concerned about high income earners paying their fair share of taxes. Last year, they actually announced their plan to examine the current regime and modify it to basically tax these high income earners. So the current legislation does have an alternative minimum tax. It imposes a minimum level of tax, and it usually applies in situations where individuals or trusts have deductions or credits. So what is this AMT? We always hear about this. We know it's a bad thing. I'll kind of give you a brief understanding before we jump into those proposals. So most people are familiar with how normal taxation is calculated. You calculate your income, capital gains are taxed at 50%. You get deductions, you calculate your taxable income, you get a tax credit, and then you apply the effective tax rate. The AMT calculation is very similar to that, except there's some changes into how things are included in that taxable income calculation. And the AMT rate at the federal level is just a flat 15% rate rather than the gradual marginal rates. So what happens is when you're calculating the normal tax, you also do this AMT calculation simultaneously. And if the AMT is higher than the normal tax, then the taxpayer has to pay that higher tax. So although again, AMT is bad, people don't want to pay it, just remember that you can carry it forward up to 7 years and apply it against taxes payable apply it against your taxes payable in the next 7 years. So let's go through these changes. So you'll see this is a list, quite a long list of the changes that are being proposed by the government. Most of them are bad for taxpayers. So the first one being that the federal AMT rate is going to go up from 15% to 20.5% in calculating the adjusted taxable income. When you look at the adjusted taxable income calculation, the capital gains inclusion rate will go up. And I should mention too that these changes are specifically for AMT. These are not for how you normally calculate tax. So for example, for capital gains, most people understand the inclusion rate is 50%. For AMT purposes, it's currently 80%. And with these new rule changes, it will go up to 100%. Capital losses enable the deduction will go down from 80 to 50% for AMT purposes. Capital gains on donations of publicly listed securities will go from 0 to 30%. Employee stock option benefits from 80 to 100%. Most deductions will now only be claimable at 50%, and same with non-refundable tax credits, they'll only be claimable at 50%. The one positive change for taxpayers is this basic exemption that applies with the AMT. Currently is at $40,000, and it will now be bumped up to $173,000 for the 2024 year, and this will be indexed annually to inflation. So let's go through a sample calculation so you can see how this will all operate. So in this situation, we have an individual who has a gross salary of $1 million, a capital gain from real estate of $1 million, an inherent capital gain of publicly traded securities of $1 million, and just assume the fair market value is also $1 million, and then he's going to turn around and donate those securities to a charity. He also has a stock option benefit separate from the salary, and he'll get the 50% deduction. So under the first column is the normal tax calculation I think that most people are familiar with. So the salary comes in at 100%, so $1 million. The capital gain on the real estate will be at 50%. The stock option benefit will be 50% or $500,000. You'll see there that the capital gain as it relates to the donated securities is 0, so there's no capital gains tax on that. And then there's no basic exemption. So the taxable income ends up being $2 million. You apply the top federal rate of 33%, and you deduct the donation credit, which is $1 million times the top rate of 33%, and you get a net federal tax of $330,000. So under the current AMT rules, you'll see in that second column what changes when you're calculating AMT. So you can see with real estate, it jumps up to 80% inclusion rate instead of 50%. There's still no inclusion for capital gains on donated securities. Stock option benefits comes in at 80%, and then you get that basic exemption amount of $40,000. You apply the 15% AMT rate, and then you get $384,000 less the donation credit. You get it dollar for dollar, and you end up with a net tax of $54,000. So because in this situation, in this example, the AMT is less than the normal tax will prevail, and the taxpayer will pay $330,000. So you can see now with this in the third column, the proposed AMT rules, the income just skyrockets. So the capital gains on the real estate will go in dollar for dollar, so at $1 million. The stock option benefit will come in at dollar for dollar, so $1 million. The capital gain on donated securities comes in at 30%, so there's a $300,000, and then you get the increased basic exemption of $173,000. So you take your adjusted taxable income, you multiply it by the updated 20.5% AMT rate, you only get half of the donation credit, and now you end up with a total tax of about $476,000. So because that $476,000 is higher than the normal tax of $330,000, the total tax owing will now be $476,000. So there's basically $146,000 of AMT embedded in there. So what does this example tell you? Well, because even though there is this basic exemption that's now higher from $40,000 to $173,000, it's just not enough to outcompete all the adjustments to the taxable income from the capital gains, the stock option benefits, the donation credits are only coming at 50%, and the AMT rate has now actually gone up by 5.5%. So moving forward, what are things that we should think about? So clearly, finance's idea of taxing high income earners is coming true. So they will likely be the ones most impacted. Ironically, the low and middle income earners will probably benefit a little bit from these new rule changes because of that higher exemption. So if you're planning for the rest of the year, if you have any big transactions relating to the sale of assets, stock options exercises, donations of securities, you might want to do that in the 2023 year before the end of this year. Some other planning points: remember that the AMT applies at the trust and individual level, and some trusts don't actually get the basic exemption. So if you have the opportunity to do some deductions, perhaps in a corporation that you own, you might want to look at that. And then lastly, just remember that the AMT is essentially a prepayment of tax, and it could be carried forward up to 7 years and applied to your normal tax. So for most people that have a salary or business income, you're probably going to be able to use this AMT over the next 7 years. So on my second topic, I'm going to be talking about the new employee ownership trust. So with this particular topic, I think finance understood that there's a lot of business owners that will be exiting their business in the near future, and there needs to be some way of providing that succession planning. Most people understand that, if you're looking at an employee that's looking to acquire that business, the employee doesn't necessarily have the funds to purchase the shares from the current owner. So the government has proposed this concept of this employee ownership trust to facilitate those succession plannings, which would allow for preferential financing options and tax deferral opportunities. And this would come into effect for transactions on or after January 1st, 2024. So there would be two main purposes of the employee ownership trust. It would be to hold the shares of the qualifying business, so this is the underlying operating entity, for the benefit of the employee beneficiaries of the trust, and it would make distributions to those employee beneficiaries based on a distribution formula. So before I get into the detailed requirements of the EOT, I thought I'd just show a visual diagram of what I think the government probably sees how this is going to play out. So if you have a situation here where you have a current owner, he owns a Target Co. shares, which is a qualifying business. It's a Canadian-controlled private company. These employees of Target Co. are essentially going to create this employee ownership trust. So the employees will now be the beneficiaries of that trust, and that trust will acquire the Target Co. shares from the current owner. To fund that purchase, they might borrow funds from the Target Co. and then use those funds to pay the current owner. So that's, I think, how the government, in an ideal situation, this is how it would play out. So what are the requirements of the EOT? So of an employee ownership trust. So the trust needs to be a Canadian resident, so mine and management needs to be in Canada. The trust must be for the benefit of individuals that are employees of the qualifying business. So there's restrictions here on the current owners or the previous owners about them being the employee beneficiaries of the trust. The trustees of the trust would need to be Canadian residents, and they would have to be elected once every 5 years by the beneficiaries. The distributions to the employee beneficiaries would be based on a distribution formula that would factor in employee length of service, remuneration, and hours worked. Remember that these employees don't directly hold the shares of Target Co., so they can't necessarily get dividends on a pro rata basis of their ownership. The trust is the one that actually owns the company. And the qualifying business must be a Canadian-controlled private company that's controlled by the trust, whereby 90% or more of its assets are used principally in an active business, primarily in Canada. Some other requirements here: the trust would be a taxable trust. So for those of you familiar with a typical family trust, any undistributed income would be taxed at the top rate in the trust. Any dividends that are passed up to the beneficiaries would retain that dividend characteristic. The shares of the qualifying business needs to be disposed of to the trust or to a corporation wholly owned by the trust. And lastly, I mentioned it on the previous slide, the trust must hold a controlling interest in the shares of the qualifying business at the time of the transfer. So what are the advantages of this employee ownership trust? So it would effectively allow employees to buy the shares of that qualifying business without having to directly pay for it out of their own pocket. They could use the funds of the qualifying business to pay out the current owner. Normally there are bad tax implications if there are loans made by a corporation to a trust or to an individual. But this is actually rectified in these rules, which would actually allow for a repayment period of 15 years. One of the other benefits is the capital gains reserve, which allows a vendor to spread out the capital gain over a period of time. The current rules only allow for 5 years, and under these new rules, the vendor could actually extend that out for 10 years. And lastly, the other benefit is that the employee ownership trust would be exempt from the 21-year deemed disposition rules that normally apply to trusts. So what are my thoughts or comments on this? You know, the key requirement when I read these rules is that the employee ownership trust needs to control the underlying operating entity at the time of the transaction. So the question I think that will come up is that will the owners be okay with giving up that control? You know, will they be okay with selling 60 or 70% of the business right off the bat, right? And now being a minority shareholder. The second point, keep in mind that the trust is not able to allocate the shares of that operating entity to the individual beneficiaries. So now it begs the question of how do you get out of the ownership? If you're an employee and you want out, is the only way out is for the trust to actually sell the shares of that operating entity? You know, does this new employee ownership trust, does that encourage employees to stay with the business? What happens if an employee wants to leave and he's helped grow this business? Again, he doesn't have shares of the entity, so how is he going to get his fair share of it? And lastly, how does this employee ownership trust structure differ from a traditional employee holding company structure where the employees might hold the shares of a corporation that then owns shares of the target company? You know, one of the main benefits of this trust is that the capital gains reserve is extended out for 10 years for the vendor, which is nice, which wouldn't necessarily happen in a holding company structure. But remember that the trust has these very specific requirements. Like the owner has to give up control. There's a fixed period for the loan repayment period, and there's no ability for the employees to sell their interests in that underlying company. My third topic, and I'm trying to whip through these pretty quickly, is with respect to intergenerational share transfer. So when we talk about that, we're talking about a situation where a current owner is going to sell his shares to, say, a family member. And for some of you're familiar with Section 84.1. It's designed to basically prevent converting corporate dividend distributions to lower capital gains. So most people understand dividends are taxed at a higher rate compared to capital gains. You know, if you look at non-eligible dividends for a BC resident, the top rate is close to 50%, whereas capital gains are only at about 27%. So in an ideal situation where you're pulling money out of the company, if there's a way that you can treat that as a capital gain instead of a dividend, chances are you're going to pay better tax and also have the ability to potentially claim the capital gains exemption. So Section 84.1 addresses this issue, and it's basically occurs in a situation where you have a non-arm's length sale of shares, for example. And what it does is if it does apply, that capital gain is recharacterized to be a taxable dividend in certain situations. Because there's no capital gain, you now lose the eligibility for the capital gains deduction. So again, this happens, Section 84.1 can happen even if there's a bona fide sale of a business to family members. So there was a lot of push from, I think, tax practitioners, Canadians, to fix this, and in 2021, Bill C-208 received royal assent that basically allowed Section 84.1 to be avoided in certain sales of businesses to family members. Finance still thought that there were some loopholes that people would utilize, and so we fast forward to the proposals in March, and they basically are now rectifying that. So before I get into those proposals, I'll give you guys a quick example so you understand why 84.1 is normally bad. So in this example, you have a father that owns all the shares of Target Co., which is a subject corporation, and his son might be working in the business, and the son now wants to take over the business. So son incorporates Purchaser Co., and Purchaser Co. acquires all of the shares of Target Co. From the father for, say, a promissory note. So if you ask the family what would they wish happened in this situation, well, the father would hope that he would get a promissory note or cash for the value of his Target Co. shares. Let's assume that they're worth $1 million. The father would report a capital gain, and he would claim the capital gains exemption, assuming it meets all the QSBC test rules, and so he would effectively not pay any tax. And lastly, the other wish that they would want is that the Purchaser Co. would get hard basis of the Target Co. shares. So if he paid $1 million, he would want his tax cost base to be $1 million. That would be the ideal situation of the family in this situation. But under the old Section 84.1 rules, I won't go through all of them, that won't actually happen. What ends up happening in this situation is that $1 million proceeds to the father will actually get recharacterized not as a capital gain but as a dividend. So no capital gain treatment, likely higher tax liability, no capital gains exemption, and ultimately no hard basis for those target co-shares now that purchaser co-owns it. So with these proposals, finance really tried to refine the changes from Bill C-208, and they said, okay, if you guys want to avoid Section 84.1, we're going to give you very specific parameters of how that's going to happen. And so these proposals would basically apply to transactions on or after January 1st, 2024. So in summary, when you look at these rules, they are basically, number one, it only applies to the sale of qualified small business corporation shares or family farming or fishing corp shares by an individual vendor. The purchaser corp must be controlled by an adult child of the transfer. The definition of child actually includes grandchildren and nieces and nephews, which is a nice change. And ultimately, the business transfer needs to happen under one of two routes, either the immediate intergenerational business transfer route, which is essentially a 36-month window for the transfer, or a gradual intergenerational business transfer, which is a 5 to 10-year window. So with respect to those two paths, I have them on my slides. I won't go through them all in detail. The main takeaway on these is the control of the business in both scenarios needs to be transferred over to the child at the time of sale. So the parents would effectively need to transfer the majority of the voting and growth shares to the child at the time of the transaction. Management of the business needs to transfer over to the child within a reasonable period. The child needs to retain control of the business under the immediate business path. It needs to be for a 36-month period. And for the gradual business transfer path, it needs to happen within 60 months or until the business transfer is completed. And the last condition is that at least one child needs to remain actively involved in the business. So under the immediate path, it's for a 36-month period. Under the gradual path, it's the greater of 60 months or until the business transfer is completed. So you can see there with those changes, if you go back to that example I gave with the father and son transferring the business over to the son, if you meet all those conditions, basically that $1 million intended capital gain will stay as a capital gain to the father. He could claim the capital gains exemption and potentially not pay tax. Other changes that will apply with respect to these intergenerational share transfer rules is the capital gains reserve period will be extended, very similar to the employee ownership trust rules, so from 5 to 10 years. The CRA will now have an extended reassessment period by an additional 3 years for an immediate transfer case and 10 years in the case of a gradual transfer. So again, that allows the CRA to go back, look at the transaction and potentially assess the taxpayer for that, so they get extra time for that, which is not good for taxpayers. And lastly, the child will now be jointly liable for the potential tax if Section 84.1 will apply in a situation where those conditions are not met. So it won't just be necessarily on the parent, the children could also be liable for that tax. So in summary, with these three topics, AMT planning, remember, we have a few months left for the 2023 year. If you're thinking about doing any big transactions, you might want to think about doing them for the 2023 year instead of deferring it for the 2024 year. And now there's some new rule changes for bona fide transfers of a business to employees under the employee ownership trust and for family members under this intergenerational business transfer. And that's it for me. So for the next topic, it will be Frank. He'll be talking about flow-through shares and the new MTax rules.
Thanks, Jamie. That was a really good segue into this presentation here because a lot of investors donate their flow-through shares for charity purposes. So my topic here, flow-through shares and the new CMETC. Thank you again for attending our session here today. And if you attended last year, we were actually able to collect some of your feedback from that to try to improve our presentation this year. So thank you again for your comments about the appreciation for graphics and the other presenters that day. We've incorporated that into this year as well. So here's the illustrated edition. And there were requests for a more detailed look at the types of filings, as well as some more details about the mechanics around flow-through shares. This presentation is going to focus more on the CMETC portion. There were also requests to have a whole flow-through share course, which unfortunately in 20 minutes won't be possible. But we'll do our best here to cover what we can. So when we look at the CMETC, it's important to look at the landscape of where it came into fruition. Canada's first critical mineral strategy was introduced in Budget 2022, and it focused on creating more jobs, growing the economy, as well as making Canada great again. And that was through making Canada the pivotal point for critical mineral exploration, as well as being a prominent country in order to do exploration work. So here you see a map of the different minerals that you can find in Canada. And some of the challenges that were faced were the risks of having the properties in a remote location. So that was difficult to do work if you can't access the site. Also, the prices of the resources were changing, and there was heavy regulation. So some of Budget 2022 was to address that. So the Government of Canada had $1.5 million slated over 5 years for infrastructure-related work to improve the whole pipeline to get critical minerals out into the industry. Also, there was $79.2 million that was given to NR Canada to allow public access to data relating to exploration work for critical minerals. And thirdly, the introduction of the CMETC here, which is a 30% credit that doubles the existing METC credit of 15%. And a lot of the framework was built off of what was already there for the METC. The changes in the provisions were brought through Bill C-32, and here's a timeline for that implementation. On April 7th, 2022, the provisions were tabled for the budget, and then on November 4th, there was a first reading of those provisions. December 8th, it was passed by the House of Commons, and by December 15th, there was royal assent on that, and it was enacted into law. So you can see it was a quick timeline where they implemented the CMETC and got it in, and it was a rush to try to get other components for that to facilitate the compliance side. And we'll get into that in later slides. Some of the ITA changes, there were additions to the subsection 127.9 definitions, critical minerals in particular, and also FTCME, flow-through critical mineral mining expenditures, and also a third one for QPG-QPE, which stands for Qualified Professional Geologist or Qualified Professional Engineer. Those were added into subsection 127.9. There are also amendments to various sections, 66.1 sub 6, 127 sub 5 paragraph A, and these just sort of build in the requirements so that the CMETC can be claimed and an ITC can be claimed on those expenditures that we talked about for FTCMME, flow through critical mineral mining expenditures. It's quite a lengthy acronym. It basically means the flow through eligible expenditures. And then lastly, there are restrictions added so that government assistance on any amounts relating to those expenditures would offset the claim. So you wouldn't be able to receive a benefit that would reduce the risk of being able to claim those expenditures on behalf or as a deduction for the individual. Taking a look at critical minerals, Natural Resources Canada has their own list of 31 critical minerals. Of that, the government has taken 15 minerals out. So these are the ones that were crossed out on your screen that you can see here. And what remains are 15 critical minerals that the government deems to be eligible for the CMETC. And why did the government pick these? Well, we'll take a look at that list and the uses here. So in a strive to have a more green and digital economy, electric vehicles and batteries are part of that. So cobalt, graphite, lithium, magnesium, nickel, and vanadium are all used in electric vehicles and batteries. In order to draw that electricity from the battery to the rest of the system, that needs to be run through copper wires. So copper is on that list. Lastly, there's also semiconductors required for that entire digital system, and gallium is used in semiconductors. The remaining critical minerals on this list relate to a transition to a more clean energy sources. So wind energy, and these wind turbines involve the use of platinum group metals, rare earth elements, and zinc. There's also scandium, which is used for solid oxide fuel cells. Tellurium for solar energy and solar panels. And then there's uranium, and the fans of Oppenheimer out there recognize that that can be used for nuclear energy. And titanium in particular was found to be able to contain nuclear waste in an effective way. So those are the last two. There are other uses for these critical minerals, but these are some that align with what the government, the direction that the government was taking. Now, Budget 2023 proposed new legislation to bring in lithium from brines as a 16th qualifying mineral. It's separated from lithium because it is extracted from a bedded deposit, and it's sedimentary. It's the most common place that lithium is found. So there's a problem here because the definition of mineral resource excludes these non-bedded, excludes these bedded deposits. So as a result, the exploration work relating to lithium from brines was excluded from the CMETC, and there was no way for it to ever be met. So this proposed legislation sort of rectifies that situation. FTC MME, as we discussed earlier, it builds upon that framework that was already there for flow-through mineral expenses, FTMEs. In this case, for the CM stands for critical minerals. So surface mining, the expenses have to be surface mining level CE incurred after the budget 2022 date, April 7, 2022, and primarily targeting critical minerals. So the word primarily there means greater than 50%. And we've already run through what qualifies as critical minerals under the Income Tax Act. The exploration work can't relate to preliminary sampling other than what they call specified sampling, and that's just testing as long as it's below a certain threshold for the weight of the minerals that you're sampling. FTC MMEs also have to be renounced after a budget date and by the sunset clause that set March 31st, 2027 as the last date. They can extend this in the future, but for now, that's the sunset clause. It can't be incurred by another corporation unless it was under a flow-through share agreement itself. And that's to prevent, a renunciation between companies that keep qualifying for the CMETC. So if it's a stacked agreement, however, that would qualify. So that's the provision there. Also, QP, QPG certified expense. So as we talked about, qualified professional engineer or qualified professional geologist. And that QP or QPG has to certify an exploration plan that primarily targets critical minerals, and it has to be certified within the 12-month period preceding the flow-through share agreement. Lastly, the expense can't be used to claim the 15% METC. Next, we'll take a look at the certification prescribed form, and that certification is done through the T100A cert. It was newly added in December of 2022, so not a lot of time to have it filled out and completed. So that first year, transition year for the CMETC allowed us to file those a little bit later, but the company still had to have an exploration plan in place that met all this criteria because that was part of Budget 2022. So here we talked about what we mentioned earlier, certified by QP, QPG, required for each flow-through share issuance targeting critical minerals and completed in that 12-month period prior. And there needs to be supporting documentation kept by the issuer in case the CRA wants to look at it. So you need to have maps of that, the mineral resource property, as well as what that plan entailed to qualify it to be primarily targeting critical minerals. Now, looking at the QP, QPG, the requirements are that the individual needs to hold a university degree or equivalent accreditation and have five or more years working in the mineral industry and for exploration work. Also, that exploration plan on the T100A cert, the individual has to have the knowledge of that exploration plan and requirements met to certify it to target critical minerals. Lastly, the individual needs to be part of a professional association recognized in the jurisdiction of that mineral property resource. And if there is no professional association there, then a general one in Canada could apply. Now, to summarize and bring all of these aspects together, we have a walkthrough of the compliance that's required. So let's take ABC Mining Corporation here, and it holds a mineral resource in Canada. The first step, if this issuer wants the expenditures to qualify for the CMETC, it needs to go out and find that QPE or QPG. And that QPE or QPG needs to certify that exploration plan. So we've got that, as we discussed. The next step here, now the company can go through its usual routine of looking through for investors and drafting up flow-through share agreements with the additional clauses for CMETC, and the usual exchange of investors giving money for flow-through shares, same thing. And the corporation can use that money to spend on the mineral resource and incur CEE, CDE, and CE for this case because that's what will qualify for the CMETC. All that information, the T100A cert, as well as the information from the flow-through share agreements, is brought into the flow-through share filings, and that's submitted to the CRA. Once the CRA processes all those details, a flow-through share ID number is issued, or T100A identification number, TIN for short. With that TIN, the corporation can then prepare its T101A and T101 slips to give to the investor. And on that T101 slip, we'll have the CMETC amounts, and the breakdown of CEE, as well as the ITCs. In this case, the ITC is the CMETC. All right, some additional comments here. The CMETC is a federal ITC, so there's no changes to provincial definitions. If you have a flow-through share agreement that's already drafted up with the words mineral exploration tax credit, I would advise you not to just do a Control F and replace on all of that and have critical added because critical minerals are not defined in that provincial space. Critical mineral exploration tax credits are also only available to individuals, excluding trusts. And you can't claim both the 30% CMETC and the 15% METC with the same expense. What that means is that if the CRA audits the company and finds that the exploration work did not qualify as primarily targeting critical minerals, then the company can't have a fallback plan to now give the regular 15% METC credit to its investors. So you have to decide early on which way you're going to follow and what's going to qualify for those expenses. Lastly, provincial tax credits will reduce the eligible resource expenditures qualifying for the CMETC. And for example, there's a 20% BC mining flow-through share mining expenditure tax credit, and that will apply first before the CMETC, and it'll reduce the amount available. So even though it's 30%, the individual might not be able to claim the full amount on their tax return. So with that, wraps up our conversation about the CMETC, and I pass it on to Raj to talk about trusts.
All right, thanks, Frank. My name is Raj. I'm going to talk briefly about the new enhanced reporting requirements that have been introduced by the Canadian government that's going to be applicable for trusts. So over the last few years, there's been a push by the government to combat aggressive tax avoidance, tax evasion, money laundering, and other criminal activity. And the way the government's intending on doing that is pretty much by gathering and collecting information. So just a brief background, in the 2017 federal budget, the government made an announcement that they were looking into new ways to collect certain information with respect to trusts. Fast forward to 2018 federal budget, that's when the government actually introduced some draft legislation that will actually require all non-resident trusts that currently have to file a T3 return and all express trusts in Canada, with certain exceptions, that are required to report additional information on an annual basis. As a result, for the 2021 and subsequent tax years, certain trusts will have to file a T3 return where there was previously no requirement for them to file a return. Fast forward to February 2022, the proposed 2018 legislation was actually quietly expanded so that the new reporting requirements would also apply to bare trust and agency relationships. Also, the government announced that there was a deferral for an additional year so that the new rules would only apply to trusts with tax years ending after December 30th, 2022. Later on in November 2022, the Finance Minister introduced Bill C-32 to the House of Commons, and that contained all of the new reporting requirements that were introduced earlier in the year. The bill received royal assent on December 15th, 2022, and everything was passed into law. However, it contained also a little Christmas gift for the tax and legal professionals. The rules were deferred for another year, and so that the new rules would only apply to trusts with tax years ending after December 30th, 2023, i.e. most trusts have December 31st year ends, so we're now in those rules. So there's two main trusts that I mentioned that are affected: express trusts and bare trusts. These are the two types of trusts that are affected. I'm going to briefly speak to each one. So what is an express trust? The express trust is actually not defined in the Income Tax Act. So we have to look under common law to see what an express trust is. Under common law, it's usually a trust that's created with the settler's express intent, and it's usually made in writing. So, for example, a family trust is a common example of an express trust because it's written, all the settler's intent is written in a trust indenture. And another example of an express trust is a testamentary trust that's created in the will of a deceased individual. A bare trust is an arrangement where a trustee holds property as an agent for a beneficiary. So these are quite common, and these allow for the separation of legal title and beneficial ownership. These type of arrangements are very commonly used here in BC and allow for a cost-efficient transfer of property, i.e. to save on property transfer tax. For example, legal title may be held by a corporation, whereas beneficial ownership is held by an individual. So bare trusts, they were previously exempt from filing T3 returns. However, under the new legislation, a bare trust is actually now considered a trust for the purposes of these enhanced trust reporting rules. However, for most other sections of the Income Tax Act, it's actually not considered a trust. So like I briefly mentioned before, there are some exemptions that are available, so trusts that are not going to be applicable to these new rules. Some of the exemptions are trusts that have been in existence for less than 3 months, trusts that hold certain assets with a fair market value of $50,000 of assets or less throughout the year. For example, assets consisting solely of money, generally speaking, publicly listed traded securities, I should make a note that the exception does not apply if the trust holds any interest in real estate or shares in private corporations. Another example of a trust that's exempted from these new rules is a trust that's a graduated rate estate, a qualified disability trust, a registered charity, or a mutual fund trust. Some more examples of exempted trusts are trusts that are governed by registered plans, for example, RRSPs, RESPs, TFSAs, RIFs. Employer profit sharing plans are also exempted. Lawyers' trust accounts, employee life and health trusts. So under this new enhanced reporting requirement rules, what are some filing requirements? The filing requirements for express trust and bare trust is that, one, they must file a T3 trust return within 90 days from the end of its tax year. And it must disclose additional specified information to the CRA. So what is those disclosure requirements? Trustees must now disclose information in respect of anyone at any time of the year who qualified as a settler or other contributor to the trust, a trustee, a beneficiary, or the protector of a trust. A trust protector is pretty much anybody who has the ability to exert influence on a trustee's decision regarding the appointment of income or capital of a trust. Some more disclosure requirements. So what's required to be disclosed? The CRA wants to know who that person is, where they live, what the date of birth is of that individual, what tax jurisdiction they reside in, all the other tax identification information, for example, a SIN, or if it's another trust, you have to disclose the trust ID number. If it's a corporation, they want to know the CRA business number. If it's foreign corp that's in the picture, they want to know what the foreign tax ID is. So what happens if you don't comply with all these new rules? Penalties. So the current penalties for not filing a T3 return, those do not change. Those are still there. The information, if it's not provided under these new enhanced reporting requirements, the penalty is $25 a day with a $100 minimum, subject to a maximum of $2,500. There's also a gross negligence penalty that comes into play where there's a failure to file the return. There's an additional penalty of 5% of the maximum value of property held during the year. Minimum penalty in that situation is $2,500. So that penalty can be quite significant where there's real estate involved in these trust structures, especially in bare trust situations, where previously bare trust never needed to file a T3 return, and now they need to file a T3 return and disclose all this information. The CRA released earlier this year in June of 2023, they released Schedule 15 that's applicable to T3 returns that must now be filed along with the trust return. So there's a lot there, but we are hoping I was talking to a couple of lawyers yesterday at a tax conference, and the legal and accountants out there were actually hoping that maybe by some slim chance the CRA will announce another deferral to these new enhanced reporting rules. That's it for my presentation, and I'm going to now pass it on to Sun.
Hi everyone, I'm Sun. I'm a principal in our Canadian tax group at Davidson. Today we'll recap taxation of equity compensation plans. We have covered this topic in the previous years, but we wanted to cover it again this year as it still is a popular hot topic, and we still receive lots of questions on this topic. So today's discussion will discuss the two most popular equity compensation plans, which are stock options and restricted stock units, RSUs. Stock options is a type of equity compensation granted by employer where employer agrees to sell or issue shares at a fixed price for a finite period. If you issue stock options, it's your responsibility as an employer to compute stock option benefit, which is a taxable benefit for the employee. It's subject to T4 reporting as well as payroll withholding such as income tax and CPP. So stock option benefit is basically the fair market value of the shares on exercise minus the exercise price by the recipient. There may be 50% deduction available if certain conditions are met. Generally, the stock option benefit is taxable in the year of exercise, but for CCPCs dealing at arm's length with the employee, stock option benefit is deferred until the shares are sold. Stock option deduction may be available. This is the 50% deduction on stock option benefit if all of the following conditions are met. One, share must be a prescribed share, meaning that it's a plain vanilla common share without any features or special rights. Two, the exercise price is not less than the fair market value of the shares at the time of the grant. And lastly, the employer and employee were dealing at arm's length at the time. If you're a CCPC employer dealing at arm's length with the employee, as long as the employee holds the shares for 2 years before it is sold, then you will be you qualify for this 50% deduction. Introduced back in 2021, stock option deduction limit. It's a limit to stock option deduction to the annual vesting limit of $200,000, which is calculated based on the fair market value of the underlying shares on the date of grant. So here we have an example. In 2023, ACO granted its employee Sam options to acquire 100,000 shares, with 50,000 options vesting equally in each of 2024 and 2025. The exercise price is $5, which was the fair market value of the ACO shares at the grant. So in this example, the total fair market value of the underlying shares at each vesting year is $250,000, being the 50,000 shares times $5, which exceeds the annual vesting limit of $200,000 by 50,000. So Sam will only be able to claim the stock option deduction on 40,000 options only in each of 2024 and 2025, and the excess, being the 10,000 options, is not going to be able to take deduction on that 10,000 excess. So the stock option deduction limit only applies to doesn't apply to CCPCs or non-CCPCs with a consolidated group revenue of 500 million. So if you are a CCPC or a small public company that's smaller and not making group revenue of 500 million, you would not be limited by this deduction limit. Other things to consider: employer may be entitled to the deduction that's the employee is not qualified for if the employer notifies the employee within 30 days of the option grant. There is also additional compliance requirement. The Schedule 59 is required with the annual T2 filing. So here's a picture illustrating timing of stock options for a public company. So at the time of the grant, there's no tax consequence, but when the stock options are exercised, the stock option benefit is recognized, as well as 50% deduction if available. And when the shares are sold by the employee, there's a possible gain or loss, capital gain or loss. There's a picture illustrating for a CCPC. As you can see here, at the time of the grant and when the stock options are exercised, there are no tax consequences. But at the time of the sale, all of the tax events are triggered. So stock option benefit, 50% deduction if available, as well as capital gain or loss. So what we discussed so far are for employee stock options, so employees only. But if you have stock options issued to independent consultants, this is taxed very differently from the employee stock options. What usually happens is the options granted to independent consultant is taxed immediately at the time of the grant. So fair market value of the options on the grant date will generally be included in the consultant's business income. And at the time of the exercise, the incremental value realized on the acquisition of the shares through the exercise of the stock option will be included in consultant's business income. So this incremental value is generally the fair market value of the shares on the exercise date minus the sum of the exercise price paid by the recipients plus the income inclusion at the time of the grant. 50% stock option, unlike the employee stock options, deduction is not available. Other things to consider, you may have sales tax obligation. This is usually missed because the options are non-cash in nature. Also, if you have non-resident consultants, it can give rise to a 15% withholding obligation under Regulation 105 if services are rendered in Canada. One area that can be problematic is the valuation of the stock options. So CRA has stated that the fair market value of an option is the greater of, number one, the trading value of the options, two, the amount by which the fair market value of the shares at the time of grant exceeds the exercise price. So if there is no market for the options and the exercise price equals fair market value of the shares at grant, then there is no taxable benefit to be recognized at the time of the grant. So to summarize stock options, stock option benefit is taxable just like other compensations and subject to payroll withholding and T4 reporting. 50% deduction might be available if certain conditions are met, and there is an annual limit for larger corporations. And lastly, independent consultant stock options are treated very differently from employee stock options. So the next item we'll discuss is the RSU, restricted stock units. What it is a promise to transfer shares or cash or a cash payment at specific time in the future according to vesting conditions. Vesting conditions generally are based on time, performance, or a combination of both. Just like stock options, it's employer's responsibility to compute taxable benefit and is subject to T4 reporting as well as payroll withholdings. For RSU, the taxable benefit is basically the fair market value of shares received by the recipients. Unlike stock options, there are no 50% deductions available. As far as the timing, it is taxable at vesting unless it's considered a salary deferral arrangement, SDA. If considered a SDA, it results in immediate taxation at grant as opposed to deferred to vesting. So it is crucial to understand what an SDA is and its exceptions. So what is a salary deferral arrangement? It's defined under subsection 248(1) as a plan or arrangement under which any person has a right in a taxation year to receive an amount after the year where it is reasonable to consider that one of the main purposes for the creation of the right is to postpone tax payable. So if you have a plan that's main purpose is to postpone tax payable, then you would generally fall under the SDA rules. There are also specific exceptions listed in the subsection 248(1). Some of the examples are registered pension plans, employee profit sharing plans, group sickness or accident insurance plans, etc. But the exception that is relevant to RSU is what's called the 3-year bonus exception. It's a plan or arrangement under which a taxpayer has a right to receive a bonus or similar payment in respect of services rendered in a taxation year to be paid within 3 years following the end of the year. So if you have a plan that structures so that the shares or cash payments are paid within 3 years after the issuance of the RSUs, then you'll be under this exception, and you will not be subject to the SDA rules. So why is it important to understand what it is? If considered a salary deferral arrangement, obviously it results in immediate taxation at the time of the grant as opposed to at the time of vesting. So you won't be able to defer taxation until later on. So here is a picture showing the timing of the RSU. At the time of the grant, there is no tax consequence, but at vesting date, taxable benefit is recognized, and possible capital gain or loss when the shares are sold by the employee. Some of the other items to consider, if you issue shares when it's vested, how to deal with withholding obligations. Some of the examples here, you can withhold from employees other cash remuneration such as salary. You can remit it first and then reimbursed by the employee, or you can reduce the number of shares to be issued to the recipients. To summarize, RSU generally is taxable and recognized. The taxable benefit is recognized at vesting and subject to payroll withholdings and T4 reporting. But if considered a salary deferral arrangement, then it's taxable. Taxable benefit is recognized immediately at grant. So it is very important to design a plan that does not fall under the SDA rules to basically defer taxation until vesting. So that concludes my part of the presentation. I'll now pass it on to Manesa.
Thanks, Sun. So today I'll be talking about a U.S. tax topic, which is PFIC, and why that's important for Canadian corporations to know. There'll be 3 segments to this discussion. The first being what is it and who does it apply to, the U.S. tax implications for the corporation, and then finally the tax implications for the investor or the shareholder. So PFIC stands for Passive Foreign Investment Company, and it has been around for a while, since it was originally enacted in 1986. And it was meant to deal with abuses by U.S. investors in foreign mutual funds or foreign corporations by expanding the reach of U.S. taxing authority with respect to passive investment income earned by U.S. persons through a foreign corporation. That means a Canadian corporation may be a PFIC to a U.S. investor. And there are some common investments that are PFICs, such as junior mining companies and Canadian mutual funds. The reason for that is that mutual funds Canadian mutual funds specifically, typically get classified as a corporation under the U.S. tax entity classification rules. And the PFIC rules work in eliminating the benefits of deferral by applying a special tax and interest charges on distributions and capital gains on the disposition of the PFIC stock starting from the beginning of the holding period. So the implications for the Canadian corporation. This means that a U.S. person who is a shareholder of the PFIC will need to report the PFIC accordingly, and this includes both individuals and corporations with direct or indirect interest. So a Canadian corporation or a foreign non-U.S. corporation could be a PFIC by virtue of meeting either one of the 2 tests, the first being the income test or the asset test. So the income test is met where 75% or more of the gross income of the foreign corporation for the tax year is passive. This is measured on a gross basis, meaning total sales less cost of goods sold. Gains, however, can be netted over losses as long as they are in the same category, and netting is allowed also between a parent company and a look-through subsidiary. If the income test is met, you basically do not need to perform the asset test. However, if the income test is not met, you will also need to test for whether it meets the asset test, which is met if at least 50% of the foreign corporation's asset on average produce passive income or are held for the production of passive income. This is also on a gross basis, which means assets cannot be netted off with liabilities, and it is measured at the end of each quarter period and taken an average of those numbers. The value is usually, the fair market value is used to test, and in some cases, the adjusted basis may be used. As part of the proposed and final regulations that came about a couple years ago, they did clarify a working capital exception to cash, where the functional currency held in a non-interest-bearing account that's held for the present needs of an active trader business, no greater than the amount necessary to cover operating expenses incurred in the ordinary course of the trader business that is reasonably expected to be paid within 90 days would be considered to be non-passive. So there is a small carve-out for working capital. So where you have a group that has a parent company and subsidiaries, it does look through to the subsidiary, meaning that the proportionate share of income and assets are used to test each of those tests. So if the company has met either the income and assets test and is determined to be a PFIC, the U.S. investor will likely want an annual information statement. This is required in order for that U.S. person who's a shareholder to make what's called the QEF election, which we'll discuss in the last section. Essentially, the statement will need to have enough information for the shareholder to include its portion of earnings of the company. So this is set out in the regulations, which states that the statement must include the taxable period or year of the corporation, the pro rata share of the company's PFIC ordinary earnings. Note that this is neither the accounting or taxable income number, but is more closely calculated similarly to cash flow. And also the shareholder's pro rata share of net capital gains to include, and the amount distributed. So for a U.S. investor, PFIC rules apply whether they have both either direct or indirect ownership. The indirect ownership rules were clarified in the recent regulations that it uses a top-down approach. For corporations specifically, if a U.S. person owns a non-PFIC corporation and is treated as owning stock of that non-PFIC corporation, it only continues down as if that person owns at least 50% of that non-PFIC. Note that this only applies in terms of a corporation structure, but not for partnerships, which is illustrated in this next example. So in this example, A is a US person and owns 40% of FC at the top, which is a PFIC. The remaining 60% is owned by B, which is a non-US person. FC wholly owns FC1 is a non-PFIC, and then below that you can see that there's FC2, that's a non-PFIC that holds PFICs, and FC3. In this situation, because A is treated as owning only 40% of FC1 and does not meet 50%, then it stops there and the other PFICs don't attribute back. So for a US investor, in terms of their reporting requirements, there are 3 ways that it can be reported. The first is the default, which is called the excess distributions. The second being the qualified electing fund election. And the third is the mark-to-market election. So the default method is essentially the worst case scenario. Excess distributions are taxed at the highest tax rate, which is calculated as either distributions exceeding 1.25 times of the average of the last 3 years' distributions, or if there's any gain on the disposition. These distributions are allocated to the prior years if it's over its holding period and taxed at the highest marginal rate plus interest charges. So something to be mindful of is if you're not reporting the PFIC properly on this form, then even though there's no form-specific penalty, there could be a significant underpayment of tax and penalties on that. If you are a U.S. investor that is able to receive an annual information statement from the PFIC, you can report your pro rata share as disclosed on that statement. Generally, this has to be made in the first year that it is acquired, and this would avoid any of the interest and special taxes. The last method is the mark-to-market election. In its name is also by election, but it must be a marketable security. So stock of a private company likely will not qualify. In this election, you would still have to report any distributions, and on top of that, also the appreciation in value during the year. However, it also is not subject to the special tax or interest charges. Lastly, to cover some exceptions, there aren't many, but if the total value of all PFIC stock owned is under the threshold and there are no excess distributions during the year, then there typically is an exception from filing. The second is that if it's already a controlled foreign corporation, meaning that there is control by US shareholders, those rules in itself trump the PFIC rules, so the PFIC reporting is no longer required. And also to note for US investors, if a investment or a foreign corporation is already a PFIC, that will always be a PFIC. That doesn't mean that the company doesn't can stop testing. As long as there are new shareholders, US investors coming in, likely they will want to know that information. Next, I would be pleased to introduce Howard.
Good afternoon, everyone. My name is Howard. I'm a tax partner here at Davidson & Company. Thank you for joining us today. My topic for today is the proposed excessive interest and financing expense limitation rule, or the IFO rule. This rule has gone through 3 iterations so far for proposed legislation, the latest of which was released on August 4th, 2023. And we're talking about it today because it will be applicable once in effect. It will be for taxation years starting October 1st, 2023, which we're now past. So to provide a high-level background, the rule is intending to limit excessive interest, so interest and financing expense, net of interest and financing revenue, IFE and IFR, that exceeds a fixed ratio of adjusted taxable income, or ATI. The fixed ratio is 40% during the transition period, which is between taxation years that starts October 1st, 2023 to December 31st, 2023. And for taxation years that starts January 1st, 2024 and onward, the ratio is 30%. To the extent that the taxpayer is able to demonstrate that the ratio of the consolidated group's net interest expense to third parties to the consolidated group's book EBITDA exceeds the fixed ratio, a group ratio may be allowed. So before we dive into the rules and how it works, you might want to find out whether or not this applies to you. So there's 2 ways to get out of these IFO rules. The first is that the definition of taxpayer, which these rules apply to, it excludes natural persons and partnerships. And second, if you are excluded entity, the rule also doesn't apply to you. So there's 3 categories of excluded entities. The first one is a Canadian controlled private corporation, or CCPC, with taxable employed in Canada of less than $50 million. So this $50 million threshold is applied to the Canadian corporation, or together with the associated group, if you're associated with any other CCPCs. So you need to be a CCPC throughout the year, and the group cannot have taxable capital employed in Canada of more than $50 million. The second category is for corporation and trust, or trust, together with eligible group entities, has net IFE in Canada of less than $1 million. So when computing the IFE of a Canadian person, it also includes any IFE of CFAs to the extent of your specified participating percentage in that CFA. So if a controlled foreign affiliate has interest expense that is used to calculate their FAPI, that needs to be picked up as well. So the limit here is $1 million, which is up from the original proposal of $250,000. The third, and certainly not least, is for a group of companies that meet 4 conditions. The first condition is that all or substantially all of the business activities of taxpayer and the group are in Canada. The second is that your foreign investment cannot exceed a certain threshold, and the threshold is compared to the greater of the book cost of investment in the foreign affiliates, which is has to be calculated based on GAAP that's accepted in Canada, or the total fair market value of all properties of the foreign affiliates, and this threshold is $5 million. The third condition is that there can be no non-resident specified shareholders or beneficiaries of any entities in the group. And last, all or substantially all of the IFE of the group is to be paid or payable to persons or partnership who are not tax indifferent, that do not deal at arm's length with the group. And tax indifferent is defined as either a non-resident person or a tax exempt entity. So to the extent that you meet one of these 3 exceptions, congratulations, the rule does not apply to you. But to keep in mind that most of these tests, you should probably wait till the end of the year because it is a throughout the year test. So things can happen during the year. For example, even if you're a CCPC at the beginning of the year, if you have a new investor during the year, that's a non-resident or public corporation, that could push you over the threshold for CCPC and taint your status. Or if you sign up for a new contract for loan in the current year, given the high interest rate now, that could push you over the $1 million threshold as well. So to keep that in mind. So the limitation, it's a proportion that's calculated, so a percentage, and the formula is IFE minus IFR, so your net IFE, minus your fixed ratio times your ATI. So basically your net interest expense in excess of the fixed percentage of the ATI. And all of that divided by the IFE, this is the percentage that's applied to each of the taxpayers' IFE. So that means if you have interest expense, financing expense, guarantee fees, or IFE of your controlled foreign affiliates, this percentage is applied to each of the amounts. As opposed to, you can pick and choose which one you want to reduce. You cannot. It's applied across the board. So going through the components, the definition of the components, these are not exhaustive definitions, but we'll just quickly go through some of them. The first one is interest expense, and it excludes amounts not otherwise deductible due to other sections of the Act. So for example, if interest is not deductible because of thin cap, you would look at thin cap first, and then you will look at the residual interest expense in this calculation. It also excludes excluded interest, which we'll discuss in a bit, and also excludes exempt interest and financing expenses, which are generally speaking interest expenses to Canadian public-private partnership infrastructure projects. And lastly, it carves out capitalized interest, as there's another paragraph that will capture this. So to avoid double inclusion, it's carved out here. It includes financing expense such as debt financing, debt restructuring cost, capitalized interest deduction claimed. So this is the deduction that you actually take, as for example, as part of your CCA deduction or your resource pool deduction. And this only applies to amounts paid or payable on or before February 4th, 2022, which was the date the initial draft legislation was introduced. And to keep in mind, the denied portion remains removed from the CCA pool and the resource pool to avoid double deduction, because the restricted interest is a new pool that gets carried forward in the future. So whatever was denied doesn't go back into the CCA pool. It remains carved out of that and then goes into a new pool. the terminal loss that represents capitalized interest, so similar to the CCA. And lastly, the relevant affiliate interest and financing expense, or RA-IFE, of a CFA generally means the affiliate's IFE for the purpose of determining FAPI and FAPL. And that's, again, to the extent of the taxpayer's specified participating percentage. IFR is the interest and financing revenue, which is similar, obviously opposite of the expense side. Just to note a few of the items here. So section 17.1 ploy, so deemed interest under the ploy elections are included here, but interestingly enough, the 17.1 deemed interest is not included here. And go on to the next one is ATI. So the ATI is calculated, your starting point is the taxable income for the year, and it's adjusted to reverse two groups of items. So one is the deductions of IFE and certain tax expenses, CCA. And two is to deduct income inclusions for interest, so IFR, untaxed income and certain other amounts. Something to keep in mind is when you have loss carried forward to a particular taxation year, obviously that will reduce your taxable income to a lower amount, so your starting point is lower. But these losses could have been generated from IFE in a prior year, and that's why the rules require that the loss carry forward to be adjusted for purposes of calculating your current year ATI. So for example, if you're carrying forward 3 amounts of losses from 3 different taxation years to current year, you actually need to do an IFO calculation for those 3 years in addition to the current year. So this could create a more administrative burden, especially if you're carrying forward losses from multiple years. So there's a new election that's available to designate the specified pre-regime losses by adding back a fixed percentage of 25% when determining the ATI for the year in which the loss is being utilized. But depending on your situation, this election may not be the most optimal, especially if you anticipate that the IFE in prior years will be a much larger percentage. In which case that will increase, if you don't make the election and the add back percentage is higher as a result of the actual detailed calculation, it may be more beneficial for your interest deductibility capacity. So in any given year, you kind of have 2 situations. The first one is if your IFE is in excess of the IFR plus 30% of ATI, you have restricted interest. And this restricted interest can be carried forward indefinitely, but is subject to loss restriction events. Or on the other hand, if your IFE is less than the 2 components, IFR plus 30% of ATI, then you have excess capacity, and this excess capacity can be carried forward for up to 3 years. There's adjustments where it gives you a funny result. For example, if your ATI is negative, it doesn't artificially increase your excess capacity. And if the group ratio is used for a particular year, then you don't get, the group cannot accumulate excess capacity for that year. Cumulative excess capacity can also be transferred between Canadian taxpayers within the same group. However, to keep in mind, there is a mandatory ordering. You must first apply your excess capacity against restricted IFE carry forward from prior years before you can use the excess capacity to transfer to another entity in the group. This is essentially, they want to make sure that if you had restricted IFE in the past and and this year you have capacity to deduct that interest, they want you to deduct that interest at that legal entity first before allowing another entity to deduct more interest. Excluded interest, as mentioned earlier, is carved out of the IFE definition, and this is something that 2 members of a same corporate group needs to elect. And basically, it's elected on it's a payment of interest from one group member to another, and it deems the payment again to be excluded from the definition of IFE and IFR. And this is to ensure that the IFO rules do not negatively impact intercorporate transactions, for example, as part of loss utilization planning. The conditions are that the amount paid or payable must be between 2 corporations within the corporate group. The 2 entities must be taxable Canadian corporations throughout the period in which the interest is accruing, and that they are eligible group corporations in respect of each other. And lastly, a joint election must be made. The election is for a single year only, so you need to make this election on a year-to-year basis, and it must be filed for the year the deduction is taken. Here's a quick example. So if you have a Canadian corporation with $50 million of non-capital loss carry forward, and you have a Canadian subsidiary with a $10 million taxable income expected for, let's say, 2025, Canco can make a loan to CanSub to create a $10 million interest expense to basically eliminate the taxable income in CanSub without incurring additional taxes at Canco level because you have $50 million of loss carry forward. So if you make the election, if you were to make the excluded interest election, this interest expense is basically carved out of both definitions of IFE and IFR. So there's no restrictions on CanSub's ability to deduct the interest this year. If you don't make the election, then CanSub's ATI is going to be $10 million as the interest expense is considered IFE and it's being added back. Your limit, and CanSub is limited to deduct only $3 million, which is 30% of your ATI. So $3 million of 10 million, sorry, 30% of 10 million. And basically you have $7 million of taxable income at CanSub level and $7 million of restricted interest carry forward. Canco, on the other hand, will have $7 million of excess capacity. And if all the conditions to transfer the cumulative excess capacity is met, the $7 million can be transferred to CanSub, such that CanSub can still take the full $10 million interest deduction. However, once again, there's a mandatory ordering rule, and there's other conditions that needs to be met before the transfer can happen. So in some situations, making the election would just make things a little easier. There's also multiple implications on the foreign affiliate side. I'll just highlight two of the items. So the first one is the relevant inter-affiliate interest. This is very similar to the excluded interest that we talked about just now, except that, first of all, it's in the foreign affiliate context, and second, it applies automatically. So there's no election for this. The rules are very complex, especially when you don't when the foreign affiliates are not 100% held. If you have differing percentages, the rules can get quite complicated. The second rule is the new FAPL rule, election, sorry. The FAPL election basically allows the taxpayer to forego the FAPL resulting from IFE of a foreign affiliate, basically to remove the RAIFE of the CFA from the taxpayer's IFE calculation, such that the Canadian entity can deduct more interest. So it's a trade-off. You do lose the FAPL, but FAPL can only be applied against FAPI. So you need to determine whether or not you will be able to use this FAPI down the road or not. If you don't think you can use this anyway in the future, then it may be more beneficial for the Canadian company to take a deduction related to its interest in the current year. Okay, and then with respect to Section 216 filers, so the current proposals has clarified that 216 filers cannot qualify as an excluded entity, eligible group entity, or fixed interest commercial trust, and the group ratio are not available for these entities. And if there is any restricted interest expense, that cannot be utilized in the future as well. So that's similar to how non-capital loss is not available. Lastly, the administrative rules with respect to the IFO rules. So there's a new prescribed form for the IFO filing. If you fail to file the form, or if you submit an incomplete form, the minister may reassess, can extend the reassessment period by up to 4 years for corporations, or 3 years for most trusts from the date on which the taxpayer files the prescribed form containing the required information. This means that the clock on the extended reassessment period doesn't start until you file the form in full, basically. The election to transfer excess capacity, the current proposal also clarified that only the transferor is required to file. This is especially helpful in a situation where you have one transfer and multiple recipients of the excess capacity. So to summarize, the IFO rules should be considered for taxation years starting October 1st, 2023, even though it's still in the proposal stage. Taxpayers should think about whether or not they qualify as an excluded entity. And they should start tracking interest and financing expense separate from their interest and financing revenue, as these definitions will be used differently within the formula. And when you are planning to apply loss carry forwards, there's a decision to be made between making an election or doing a detailed calculation to maximize the capacity for interest deduction. That's it for my segment. I will pass it on to John.
Hi everyone, I'm here today to talk about the Underused Housing Tax, which is Canada's latest and greatest way to go and tax the value of your home. By way of introduction, though I'm sure many of you have heard of this by now, this is implemented in effective for 2022, and the goal is to go and target non-residents that own residential properties. Fundamentally, it's a 1% tax on the value of those certain residential properties, and it's assessed based on the ownership at December 31st of any particular year. Even though this is meant to target non-residents and foreign entities, there's a very broad and recurring filing requirement that affects almost everybody. The good news is that owners may often qualify for an exemption from that tax. The bad news is that there's lots of filings. So this is sort of a table to outline what the different obligations are for those subject to the UHT. So if you're considered to be an excluded owner, you can basically forget that the UHT exists. You don't need to file anything, you won't owe any taxes. If you're an affected owner, what that means is that you're going to need to file a tax return. Whether you owe tax or not is going to depend on whether you qualify for an exemption or not. So why should we care about all of this? It seems like every year a new legislation is introduced provincially or federally about, you know, the speculation tax, the vacancy tax, and, you know, now we have the underused housing tax. And the answer is always the same. We're all just here because we don't want to get fined. So the penalties in this case, you're looking at about $5,000 for individuals or $10,000 if you're not an individual as a minimum. If you're in the unfortunate circumstance where you also happen to owe tax, your penalty will end up being calculated as a percentage of that UHT payable owing and will be expanded based on every month late that filing can end up being. The other thing that you should care about is retaining the records that relate to these UHT filings. If your records are found to be insufficient, then the CRA reserves the right to overturn the exemption that you were previously given, assess tax, and then, you know, if you're filing late, then you're going to end up with those percentage-based penalties as well. So, excluded owners. Being an excluded owner is a good thing. The biggest criteria that most people will fall under is if it's an ownership by an individual who's a Canadian citizen or a permanent resident. So anybody that owns their house on a simple basis in their personal name are not subject to anything related to the UHT. You don't need to file, you don't need to pay tax. The exception, though, is if you are an individual that holds an interest in that property as a partner of a partnership or as a trustee of a trust. Those are not included in this exclusion criteria. That first big bullet point there is essentially talking about public companies. Canadian public companies are excluded owners. Registered charities, cooperative housing corporations, municipalities, other governing bodies like the government, or if you have a publicly traded mutual fund trust or SIFT or REIT, those ones will also be considered to be excluded from all of these UHT rules and certain other public service bodies. So affected owners, and if you recall back from that table, these are the ones that actually need to file the UHT returns. So affected owners are privately held corporations that are incorporated in Canada, corporations incorporated outside of Canada, individuals who are non-residents, and as mentioned previously, if you're a partner of a partnership or a trustee of a trust. So all of these UHT rules, they all relate to whether there is a residential property in question. So what is a residential property? And in this case, it includes all of these things that you would normally expect to be a residential property. A house, duplex, laneway houses, Cottages, cabins, and chalets, as long as they're not for commercial use, which I'll get to later. Semi-detached houses, stratified condominium units, row houses, townhouses, all of those sorts of things. So then we get to non-residential properties. So non-residential properties, also a good thing. If you have something that's not residential, then you are not subject to the UHT regime. And as a rough guideline for how to approach this, I would say is ask yourself, is this a business when you're looking at that property? It's not perfect, but it'll be a good guideline for at least as a litmus test for figuring out whether it's a residential or a non-residential property. So the first one is buildings with more than 3 dwelling units. A dwelling unit is specifically defined as having a private kitchen, a bath, and a living area. I suppose a bedroom is not necessary for a dwelling unit. Maybe you can sleep in the kitchen. A high-rise apartment building. Buildings that are primarily, which as my colleagues have noted in these sessions, means more than 50% for retail or office use and that contain an apartment. Commercial condominium units, boarding houses, lodging houses, cottages, cabins, and chalets that are for commercial usage. And to clarify this, it's used by an operator where they're providing lodging to several unrelated business or leisure travelers at one time. Hotels, motels, inns, floating homes, travel trailers, motorhomes, all of these are not subject to the UHT, as they are all non-residential properties for the purposes of the UHT. So now we've determined that you're an affected owner for the UHT. So how do we get you out of paying tax? And we have to look at these exemptions. And you'll see here the most important one in my mind is the type of owner. And the reason I bring this up first is, as I mentioned about the retention of records earlier on, the type of owner is something that is very easy to go and substantiate. That's not something that will likely change very easily. You don't need to keep lease documents. You don't need to have a litany of paperwork. It should just be intrinsic to the nature of the ownership. So the first one here is a specified Canadian corporation. This is a bit of a negative test, so it's saying where foreign owners do not own or control, directly or indirectly, 10% or more of the corporation, and that's determined by either share value or by voting rights. As we mentioned previously about partnerships and trusts, if it's a specified Canadian partnership or a specified Canadian trust, you're looking at the partners or the beneficiaries of that trust, whether they are excluded owners or specified Canadian corporations. One interesting point for these two is that there's a discrepancy between who actually needs to file the return and where the test is being conducted, because the person who files the return is going to be the trustee or the GP of that partner, of that partnership, but they're not necessarily the ones who are entitled to the cash if that property is sold. Another exemption here is for a new owner. If that owner acquired the property during the year and was not an owner of that property at any time in the previous 9 years. This slide here is generally dealing with situations related to the death of an owner. So if the owner died during the year or in the previous year, or the personal representative of that deceased individual, so the executor, and that person was not an owner in either of those years, or if there's a co-owner of a property where that co-owner held at least 25% of the property at the time of their death. So that would be in more spousal situations. Then we get into some of the other exemptions for the availability of the property. So the first two there relate to construction activities. If the property is under construction and is not substantially completed before April, then that property would be exempt. The second point is if the construction of the property is substantially completed before April, so it's done January, February, March, and that during the whole remainder of the year, that property was offered for sale to the public, but was never occupied by an individual as a place of residence. So this would be if, there's a builder and they've constructed a property, they've tried to sell it, but they're unable to sell it, would be where this fits in. A property that, and my next few are about the ability to actually live in that property. So if it's not suitable to be lived in year-round or seasonably inaccessible due to public access not being maintained year-round. So let's say that you have a house on an island somewhere, and it's in an island in the middle of a lake, and the lake freezes over and you can't safely get to that house, then that lakeside property is not going to be or subject to the UHT as a result of this exemption. The other two is if the property is uninhabitable for some extended period of time due to a disaster or hazardous conditions. So it'd need to be at least 60 continuous days for a disaster or hazardous condition. And then the other one is if the property is uninhabitable due to ongoing major renovations. For these exemptions, there's a limit to once every 10 years for the major renovations, so you can't keep claiming it over and over that you're majorly renovating your property. And the other one is for every 2 years for the same particular disaster. Next exemption is for the nature of the occupant. So this generally deals with who is actually living in that property. And it's talking about individuals who are in that property for at least 180 days in the year. So this is going to cover your rental circumstances, an arm's length individual who occupies the property under a written agreement. The second point there is for non-arm's length individuals. So, you're renting it to your cousin, but it's trying to go and accommodate for this where if you're not giving them a special deal on the rental price, and that rent is being charged at least at 5% of the value of the property annually, not monthly. That would be very scary even for Vancouver. The owner or their spouse or common law partner, while that individual is in Canada for work, or the owner or their spouse or common law partner, parent or child who's a Canadian citizen or permanent resident. And then, of course, if it's the primary place of residence for a particular person, then they would be exempt there too. The last exemption criteria is about the location of the property. So what CRA has done is they have a very helpful website where you can punch in the postal code of a particular property, and it will tell you whether your vacation property is rural enough or in whatever eligible area that they've determined is good for an exemption criteria. And if the owner or their spouse or common law partner are in that property for at least 28 days during the year, then that will fulfill an exemption criteria as well. So now we've gone through, we figured out that you're an affected owner, we figured out that none of the exemptions we just talked about actually apply. So now we have to figure out how much that you actually owe. So in general, as I said at the start, this is based on 1% of the value of the property, but what is the value? So in this case, we're looking at calculating it using one of two methods. The first is the taxable value, and what that refers to is property tax assessments. So you're looking at the greater of the assessed value for the year for property tax purposes and the most recent sale price, and then that is applied to whatever your ownership percentage is of that property. The second is the fair market value. So this is an election that takes place in the same UHT return form. What's done here is that the owner is clearly dissatisfied with the property assessment value or whatever the most recent sale price is, and they want to get their own appraisal done by somebody who is an accredited appraiser, and they use this value for determining the amount of the tax. Again, this is applied towards that person's ownership percentage, and then tax is assessed at 1% of that particular value method. Then we get to actually filing the tax return. So the name of the form is the UHT 2900. The point here is that it must be filed for each owner for each property. So to clarify this, let's say that you have husband and wife each own 3 properties together in Canada, but they're non-residents. So they are affected owners for the purposes of the UHT. We're going to end up having 6 returns filed total. Husband has to file 3, 1 for each property. Wife needs to file 3, 1 for each property. The return is normally due on April 30th, but for 2022, because this was a very fast and loose circumstance for this year, they've provided transitional relief where as long as the return is received before November 1st, then they will not apply all those penalties that I mentioned previously. One other point for our very remote work era is that CRA has confirmed that electronic signatures are acceptable for the UHT returns, so you can feel free to go and use those. So the remainder of my presentation is just going through some examples of what I think are helpful or common scenarios for UHT filing. So my first one here is about an apartment that's owned directly by a Canadian individual. You know, it's used a bit by their family. It's rented a bit out for short-term rental, like an Airbnb. There's no filing required, and there's no tax required. And the point here is that the whole analysis can stop before you even get to any of those underlined words, because it's a Canadian individual who owns that property directly, and they're therefore an excluded owner, and it doesn't actually matter what they're doing with their property. So example 2, we have a detached house that's owned by a private Canadian corporation, of which all the shareholders are Canadian citizens. The house is rented out to a consistent long-term tenant, which we'll say is at arm's length. So because it's owned by a Canadian corporation, there is a filing that's required. But because it's a specified Canadian corporation, an ownership exemption would apply here. Further, you could also claim an exemption based on the nature of the occupant for that long-term tenant. As I mentioned previously, though, what I would encourage people to do is to use the exemption for the ownership, because that's something that'll be much easier to substantiate than, say, if you had a tenant where they have a 1-year lease agreement, but they've signed on month to month thereafter, and there isn't the same level of documentation for years 2 to 5. Example 3 of a large residential apartment building that is not stratified with 60 units and is owned by some non-Canadian corporation. The properties are all rental units that are managed by that same corporation. So in this case, the property would likely not meet the definition of a residential property, which would exempt it from filing the UHT. Beneficial versus legal ownership. I put this in here just to highlight for my next couple examples, and because it is quite a large issue. So my colleague Raj had talked about this earlier, about the difference between legal and beneficial ownership and in the context of bare trust arrangements. So to review, legal is when you have the name on title with the land title office, but the beneficial interest is who actually has the entitlement to the cash if and when they sell that property. It's the legal owners who are required to file, not the beneficial owners. But what happens with all of these bare trust arrangements? The bare trust arrangements are generally where somebody is holding legal title, but they are not holding the beneficial interest in that property. This is a very high-risk area because bare trust arrangements have been used for planning by accountants and lawyers for many years, and they're generally off the grid other than perhaps for these new T3 reporting requirements. So there's a major detection issue here where people might have entered into these bare trust arrangements for a number of years, and they've perhaps completely forgotten that those bare trust arrangements have existed. And because nothing has been filed, there's an almost unlimited potential for penalties to apply there. So if you think that you might have a bare trust arrangement and you need to get caught up on your UHT, that's definitely something to give us a call about. So I've kind of sold the farm here in advance of this example, but we'll go through it anyway. A cottage is jointly owned for many years by a married couple. They create a joint spousal trust on the advice of their lawyer and transferred the beneficial interest of that cottage into the joint spousal trust. To avoid the application of the property transfer tax, the couple also entered into a bare trust agreement where they personally maintained title onto the property. All beneficiaries of both trusts, that is the bare trust and the joint spousal trust, are Canadians. So a filing is again required. This would be for each individual that is considered to be a trustee of that trust. Often it would be both spouses in this case. But again, there would likely be no tax because it would qualify or should qualify as a specified Canadian trust. And then the last example that I have here is about a limited partnership that owns several residential properties. The general partner, or the GP for the partnership, is on title for all the properties. The GP is a specified Canadian corporation. The limited partners are a mix of Canadian and non-Canadian investors. The properties are used exclusively for short-term rentals in major metropolitan cities. So in this case, a filing is required for the GP, as it's the one that's on title for those properties, and the tax is probably applicable, assuming that there's no other exemptions that they would fall into, because not all of the owners are excluded or specified Canadian corps. So as a summary, just a couple big point takeaways. There are lots of UHT filing obligations, and they're more common than you might think. You should strongly consider the applicability of bare trust as an easily missed filing requirement. And if you somehow forget or neglect these obligations, there are significant penalties for non-compliance. So I'm going to pass this off to Les to wrap us up.
All right, thanks, John. Appreciate that. That was great. And thank you to all our presenters today. Hopefully everyone was able to take away something from all of those topics. I know there's a lot of changes that came through, and everyone's sort of got a different target as to what they want to see in our presentation. So hopefully you saw some valuable details that you can use and apply. So before we wrap up, of course, I just wanted to mention again, there's an area where you can put in any questions. So as always, we welcome all your questions. We'll try and get back to you as soon as we can with responses and anything that we can do to help. And before we wrap up, I just wanted to go through a few takeaway items from our presentation today. So first of all, thank you again, Jamie, for the discussion on AMT, so the alternative minimum tax. Couple of key things to take away from that and that are more time sensitive. So this kicks in 2024. So it's something that you want to look at from a planning perspective. If you're looking to donate public company stock, you may want to consider doing that before the end of the year so that you can take full advantage of the current rules, as they will change quite dramatically in 2024 and may not end up with the same result that you've had until now if you're often sheltering your income with such donations. Same goes for selling a business. We're getting pretty tight on the year end, but if you're planning to use your lifetime capital gains exemption, that can be reduced in ability to reduce your taxes with the new AMT rules, and it can be difficult to use those credits that result from AMT paid since you only have 7 years to use them up. And so in situations where you're selling a business, you may not have the income in later years that you can use those credits. So keep that in mind as well. If you're looking at in the process of selling a business, you may want to get that deal closed before the end of 2023. And same goes for the stock options. I know a lot of you out there hold stock options and have not exercised them. Certainly with the changes with AMT, the taxes on stock options will likely be more punitive with the new rules. So you may want to look at whether it's worth exercising those before the end of 2023, before the rules change again. And one more point as well on the UHT returns, of course. Make sure if you do have residential property, as John mentioned, the deadline for that is October 31st, the extended deadline. Going into the new year, 2024, it'll be April 30th. So if you do hold any kind of residential property, rental property, things like that through a corporation or a trust, you may want to have a closer look at that so you don't get hit with those very punitive late filing penalties. So I think that's probably a wrap. Just a couple of housekeeping things to mention. Please do fill out the survey. It'll provide you with a link to the PD certificate. I know many of you require your PD credits, so please do fill in the survey, and you'll also get a copy of the slides so you can refer to later. There's also going to be a video recording of this posted on our website if you'd like to see any sections again or review anything that you may have missed on the original. And then a couple of more events coming up. So November 2nd, we have our IFRS update. Same thing, 2 to 4 o'clock. And as well as the regulatory and TSX update that'll be happening January 17th. So again, from all of us here, thank you again for joining us today, and have a great afternoon. Bye for now.